Hi everyone. We're just going to wait a minute or so just to give people time to log in. I just want to thank you for taking the time this afternoon to listen to the webinar, which is going to last for about 30 minutes. I'm delighted to say that I'm joined by Ian Slattery, who's an investment consultant with Zurich Life. I've done a couple of sessions now with Ian, and Ian's really knowledgeable in this space, and I'm delighted to have him here. I'm conscious that some of you might be listening to this on playback, so obviously we want to keep it kind of as informative as we can. There is an opportunity for people to ask questions in the chat, so please feel free to do that, and we will have an opportunity to take some questions at the end. Basically, the format today, guys, is going to be a bit of Q&A towards the end. Ian's going to have about 10 minutes just to talk about Zurich, the, I suppose, performance of some of the funds and just the market in general. Quite a few of you on the call today will have invested with Zurich in some capacity, and I think it's really good to get a sense of, I suppose, the way in which Zurich see the world, but also invest monies. So I'm going to start off by just giving you a little bit of an insight into ourselves. Some of you may not be familiar with Alpha Wealth. We're a financial advisory company based in Little Island in Cork. We have a small presence in Dublin. There's currently 8 of us in the team. Myself, I've been a financial advisor for over 20 years now, and I'm ably assisted by Keenan Cunningham today, our marketing manager, and also by some of my colleagues who are on the call, David Looney, financial advisor, Clint O'Donoghue, and others. So with regards to the advice that we give clients, and really the focus for today is about investing, whether it be for children's education, whether it be for a new property that you're looking to buy and to try and build up a deposit, or if you're looking to switch, or indeed for retirement. I think there's always reasons for us to invest and save money. And as you can see from the slide here, hopefully there's various different areas in which we can, I suppose, put funds into. And really, financial planning for me generally tends to be about balance. It's about making sure that you're spending your money appropriately in these various areas. And sometimes it's just a case of a check-in with a financial advisory firm. One of the key things for Alpha Wealth, and I'm delighted to say, is that we are an independent broker. We deal with all of the insurance companies. We have a great affiliation to Zurich, and I myself personally have my pension scheme with Zurich and my own personal investments. But it's great for us to be able to talk to clients about the market in general. Now, with regards to, I just threw up this slide. I actually took it from RTE last night. I'm not going to talk about pensions today, and that's for a kind of a separate conversation, but many of you have a pension scheme, and as you can see here, quite a few people, particularly if you're in your kind of early 20s, probably don't have a pension scheme. And it's really something that I would suggest that all of you would check in on. I spoke last week at a webinar, and we will be doing further webinars as the year progresses, just to ensure that you are utilizing opportunities. And I do think that pensions are completely underutilized, which is why I suppose it was covered on the news yesterday evening. So just before we kind of talk, and I get Ian to talk about savings, I want to just mention that, as all of you are probably aware at this stage, the post office, bank and credit unions are not serving us in relation to paying interest on accounts. And that's really the main issue for most of us. So anyone who has money that are looking to maybe not put it to use in the next 12 to 24 months, I do think that it is forcing us to look at other options. I'm approached daily at this stage by people who are looking to invest in things like cryptocurrencies and NFTs and other instruments like that. And I've said many times that I'm not against people investing in these areas. It just has to be proportionate to the amount of money that you have and really what you're investing for. I've a client who was looking to invest in cryptocurrencies for their kids' third level education, and the alarm bells were ringing for me. I've emphasized to people that whilst it is an asset class and maybe it does warrant people considering, you really need to be very cognizant of the risks that are involved. And I think Ian's going to talk about that over the course of the next 10 minutes or so. Now, before Ian does, I just want to give you kind of a very specific kind of overview of the type of opportunities. And Ian's going to talk a little bit more about the investment style and the approach. But just to put it in kind of, I suppose, simple terms for us all, Zurich provide what I believe to be the best savings plan in the Irish marketplace. The reasons I like it are that it provides complete flexibility of payment. The minimum contribution level is €100 a month, or you can start with an investment of €5,000 or more. And what I like about it particularly is that there's no penalties to take the money out of the account, whether it be after 6 months or 6 years or 16 years. It offers complete freedom of being able to access your money when you want it. The key thing, I suppose, for clients out there is that I always say this, that you need to be cognizant of the fees you pay. And believe it or not, that there are different fee structures, even with Zurich products, depending on the type of advisor you go to and depending on when you bought these types of products. So it's always worthwhile just checking in and seeing what you're paying for these schemes, and obviously making sure that you're getting the lowest fee possible. I've said on record, I'd like people to see Alpha Wealth as a low cost company. We offer 100% allocation to these savings plans and to our pension schemes for that matter. And I'd like to be able to kind of say to you that it's just worth, even if it's a case of putting new contributions in. So, for example, if you've set up these savings plans in the past, or indeed did it for your first child and you've subsequently had more children, it might be an opportunity for you to look at these types of plans and just make sure that you're invested appropriately, which Ian's going to talk about further. Um, this slide here just makes reference to, I suppose, getting your money working harder for you, the access that I mentioned. And really, the main piece, I suppose, that I wanted people to get from today is that not all investments are the same. And it's really, I suppose, important that you are aware of where your money is. So, for example, the table that you can see here on the screen, the risk profile really runs from 1 to 7. One is your kind of bank account, credit union, post office account, which is paying no interest, and it's sitting secure, even though inflation arguably is eroding that money. So you're effectively losing money by leaving money in the bank. The other side of the scale is high risk investments, typically your cryptocurrencies, Far East Asian equities, and so on. And then you've got this kind of whole myriad of different options in between. And this is where we work with clients and help them decipher what is most appropriate for them, whether it's for their retirement saving, whether it's for their kids' education, house deposit, and so on. I'm going to talk to you very briefly now, and I don't want to kind of tread on Ian's kind of presentation, but just to kind of finish off, one of the major things for anyone who is looking to save or has money and disposable income is that the effect of compounding is really powerful. Einstein spoke about it as one of the most powerful forces in the universe. And the key thing is that if you earn interest on your money and as it accumulates over time, the compounding effect of that is huge. It really is. And you can see here from this slide, for example, for people who are saving for their kids, I have 3 children myself, that if you are starting putting in, say, the children's allowance, let's say from the age that they're born, over a period of 18 years, you can accumulate of a fund of about 42,000, which in my opinion, I think is sufficient to get most children through third level education. Now, obviously, inflation will have some impact upon that, but it's a really good place to be. Now, obviously, if you have children who, for example, are 5 years of age or 10 years of age, and you're only starting then, it may be a case that you need to think about, obviously, what level of contribution you're putting in and whether you have the opportunity to put in a lump sum. The final slide I want to go through very quickly, and I'm going to let Ian talk. People are probably sick of listening to me at this stage, is that you can see the effect, I suppose, of this compounding, even at relatively moderate contributions. So this slide here, it's a bit fussy, but it shows you for someone who's saving the minimum contribution to the savings plan that I mentioned, the €100 a month, over a 5-year period, what is a fairly moderate rate of growth of 4% net of tax and fees, it's going to generate a return of about €6,759. And then if you extrapolate that out over 10 years, the figure is closer to 15,000. And the same, I suppose, example for €500 a month shows figures of around 33,800 and 75,000 euros. So what we're showing you here is that you can see over time, even at relatively moderate levels of contributions, you can build up quite a significant amount of money. Okay, so without further ado, I'm going to pass on to Ian Slattery. And as I said, if anyone does have any questions, do please feel free to ask them at the end or put them through the chat, and we will endeavour to get back to you.
Perfect. Thank you, Nick, and good afternoon, everybody. So look, just as Nick has outlined, I'll keep you for about 10 minutes. I just want to go through a few bits and pieces in terms of the current thinking from myself and my colleagues at Zurich Investments. A little bit about performance in terms of some of the funds that are utilised by Nick and the team at Alpha Wealth, and also just one or two little principles of investing. So as Nick had says there, we'll have a chance for some Q&A if people do want to kind of ask questions or for me to elaborate on anything I'm going to touch on. What this first slide just shows us is the 7-year story of the stock market from 2013 through to this week. And you can see this is for 100% equities, so that would be higher on that 1 to 7 scale that Nick outlined. But you can see it's a nice broad picture upwards, well over 150% growth for equities over a 7-year period, but not without its ups and downs. You can see we had the Chinese stock market crash in 2015. We had Brexit, which was unbelievably over 5.5 years ago now in terms of the vote, and then we had the Trump election a couple of months afterwards, but 2016 was actually a positive year for stock markets. We had a bit of trouble about interest rates in the fourth quarter of 2018. That's a topic that we'll return to. But you can see obviously about 2/3 across on that chart, the big fall off from the COVID pandemic and the bear market that came, the recession that came as part of the COVID pandemic. However, the recovery was swift. People who stuck with their plans, stuck with their financial advisors, such as Nick and the team, saw their money recover very fast in terms of a 100% equity portfolio. And there was a nice broad picture for positive in 2020 into 2021. Some of you who follow the news cycle will be aware that we've had a rough couple of weeks, but you can obviously barely see that on the last slide on the right-hand side. It was almost indiscernible in terms of the 7-year picture. And so you can see just there on the very right-hand side, stock markets have fallen in 2022, but they're back at a level where they were maybe in August, September of last year. So a couple of months growth, a few months growth has been pushed back. So there's a lot of noise at the moment, and it does hurt behaviorally. We scream at this and we want to do something all the time and fix it or whatever it might be. But if you take out a little bit of perspective in terms of what the story has been like, including the biggest shock in over a decade with the COVID pandemic, it's still a broad picture, and we see ups and downs the whole time, but a little bit of perspective is always useful. Just to come through to the next slide, I mentioned some of this jargon already, and I think it's always useful to kind of decipher some of it. So a bear market is 20% fall from the high, and so that's what we would have had in March 2020 with COVID. We're actually now in a correction in 2022, so we have seen a fall of more than 10% for certain stock markets, some of the more tech-heavy markets. We did actually have a recession in the Eurozone in 2020, not in Ireland, but we did see 2 successive quarters of negative GDP. But we also saw a bull market in 2020, the start of a new bull market. So we saw, as I said on the last chart, a very quick rise off the bottom of more than 20%. And my favorite one I remember having to look this up myself at the start of my career about what a black swan event was. And I think as you read that out yourself on the right-hand side, I think we can all agree that that's exactly what the COVID pandemic was. But for us as active investment managers at Zurich, this sort of pandemic and what happened also creates opportunities. So we believe in geopolitics, in tech, in big government, in health, and the rise of the new consumer. We have opportunities of active managers, and we're excited about this new paradigm for investing. I've been using this slide for a while, but I think it's fair to say geopolitics is on the agenda at the moment with what we're seeing in Ukraine and a bit further away in Taiwan. Just in terms of that particular aspect, we do believe it's going to cause headlines. It might start a war, but always remember that headlines on the front page don't always drift into the business pages. Okay, and what I mean by that is there might be terrible things that happen in Ukraine. There might be a political and a military standoff between the world's superpowers, but that may or may not affect stock markets. Geopolitics in the past have been very loud, very noisy, but at some stages haven't actually affected the market as much as we think. Tech wars, we see the rollout of 5G, we see Huawei being limited in its business operations in parts of the globe and things like that. And the geopolitics is probably confined a little bit between the US and Russia at the moment, but the tech war is going to be the real Cold War we see in this decade between the US and China. Depending on your political alignment, you might believe that big government is a good or a bad thing, but I think we can see certainly as the response to the pandemic has come through that the government is playing a bigger role in all our lives at the moment. Health as well. I know this isn't a webinar to touch on protection products or anything like that, but we're all I'm certainly more aware of work-life balance, our own health, looking after our families and things like that. I think that's a key takeaway we can all take from the pandemic over the last 2 years. And we have a new consumer. We have the Zoomers, the next generation. We're all on Zoom now, and you see people, the first cohort of people leaving second and third level education, who for them the normal is not being in an office, wanting to remote work, wanting to be at home is their natural habitat now as workers. And how companies interact with that and pivot to it and adapt to it is really, really important. So a lot of these trends were already in place, and we feel that the pandemic has accentuated them. And at Zurich, we've been negotiating and navigating these stock markets, keeping an eye on these longer term trends to help provide the returns that we see in our fund performance we'll come on to. So we look a little bit ahead, roaring or roasting in the 20s, if we think of the roaring 1920s that followed World War II. The view from Zurich, and again, as active managers, so top-down investors, we're looking across the globe, we still maintain a preference for equities. And even as we see the correction and we see some of the bad news so far in 2022, for us, the longer term trend for equities is intact, and we firmly believe on that. In terms of government bonds, bonds are a very interesting investment. They can be very safe for us, and they can be a best place to be. We're looking to de-risk. However, when we look at the interest rate environment and the inflation figures we're seeing at the moment, for us, there's some risks in sovereign bonds. So as an active manager within our multi-asset funds, such as the Balanced Performance Dynamic or the Prisma range, which are our most popular funds, we have a preference for corporate or company debt over government or sovereign debt. Within equities as well, we're trying to make decisions that we're making plans based on some of those topics I showed on the last slide, and we still maintain a preference for growth-orientated stocks like technology companies versus value-orientated, which would be more staples and utilities, for example. But to sum up the view from Zurich is, when we look at equities versus other asset classes, including bonds or cash, we still believe equities offer the best risk for return trade-off for investors. And that's how we're positioned across our funds. So if we want to pull some of this all together in terms of looking back, knowing what's happening in the markets, seeing what trends might come, and having a view as an active manager, that all goes into our decisions, which leads to our fund performance. So again, I have Prisma 3, 4, and 5. You can see the blue bars rise as you go up the risk level. That's the point that Nick touched on already. But what we have here is the blue fund, which is Zurich, the red, which is the market average, and then the green is the difference. So many of you who are invested with Zurich via Nick and the team at Alpha Wealth will be invested in Prisma 4, which is our most popular fund with over 2 billion assets under management. A lot of people will save for children's education or house deposit with that particular fund. You can see over each of the last 5 years that Zurich Prisma 4 fund has outperformed the average by more than 2%. And Nick showed on the savings projection slide some of the compounding effect and the positive story that can tell. If we look back a little further into some of our other funds, which many of you might invest in terms of the balanced performance and dynamic, as we go through to the next slide, you can see that long-term outperformance from Zurich is very, very clear. We have the 3 Zurich funds in the 3 shades of blue, and we have over 1, 3, 5, 10, out to 15 years, a couple of % added every single year from the team at Zurich Investments based on our active investment process. So we are always worried about the markets. We always keep an eye on them, but that doesn't mean that we stick to our process. It means we stick to our process. We have a consistent process for over 30 years, and it's to help people save for the long term. Nick made a really good point with that screenshot from the RT News, because if you take here, I have 4 investors, all investing the same amount of money at the same growth rate, but one starts at 25, one at 35, 45, and 55. So the same experience once they start, but you can see the massive difference in terms of outcomes, in terms of the positive nature of our pension pot of the person who started investing at 25 versus the person who only started at 55. So similar to what we see in the savings club and saving for a child's education or a house deposit, the same principle applies to your pension. You invest early and often, you'll see the returns over time. Just turning to my last slide, and I'll hand back to Nick after this one. I think this is really, really important when we see times of stress like we're seeing now in the stock market. This looks a little bit busy or fussy, as Nick referred to one of his slides earlier, but if you bear with me for a moment. What I have here in the dark blue line is equities. In the beige is bonds, and then the lighter blue is a 50-50 portfolio. And if we take the dark blue bar on the left-hand side, in any one year over the last 50 years, you could have got plus 61% from equities, or you could have got minus 43. We see a narrower range for bonds, and then somewhere in the middle for the 50-50 portfolio. I won't go through every aspect of this, but as you look at this picture, just have 2 takeaways. The longer we invest, the narrower the ranges get. We have more certainty in our outcomes. And the longer we invest, as we move from left to right through the time periods, it skews upwards. So that should tell us, even in times of stress, the longer we invest for, the more likely we're going to see a positive return and more certainty we have in terms of a narrower range. So look, in summary for me, I think it's always important to look at the kind of the 7-year picture or longer in terms of perspective for stock markets. It's always good to know what some of these phrases mean. As an active investment manager in Zurich, we're always looking ahead, trying to take into account all these factors that are happening. As I showed on our 2 performance slides, I think that the proof is very much there in terms of the outcomes for people who save in their investment or their pension with Zurich. And my last 2 slides are just kind of 2 key points in terms of investment principles. Things that we should always have in the back of our head in times of stress is start early, stick with the plan. And again, as I show on this slide here, over the long term, investors do get rewarded. So a whistle stop tour there for me, but more than happy to take any questions, and I'll pass it back to you, Nick.
Thank you very much, Ian. I really appreciate the insights. And as you said, we launched the Zurich Alpha Savings Club last year, and we've been getting phenomenal kind of support in it, which is based on the savings plan that I alluded to, and it's really focused on helping people to save over, the medium to longer term. And by that I mean typically kind of 3 years and longer. I don't believe that it's really sensible for anyone to invest for any period less than that. So Ian, I'm just going to ask a few questions. We did get some questions over the course of the week. And if it's okay, I'm just going to kind of pepper a few at you. Yep. I forgot to mention at the start that we are running a poll. I can see quite a few of you have been answering about, it's a question just asking how much do people usually save a month. So I'll put the results of that up at the end. But Ian, just for anyone who hasn't kind of saved into the type of products that we've been discussing, can you just give a kind of a view as to how you'd compare them to, say, the traditional kind of bank, post office, or credit union, please?
Yeah, so I think the first thing is, and I know this yourself and the rest of the team would be impressing this on people, it's always good to have an emergency fund, and that should be in somewhere safe like the post office or the bank account. However, when we look at things for longer term, so as we say, 7 or 10 years plus for a child's education, for example, there's loads of money on deposit. So Irish people are saving more than they ever had. It's earning less money than ever because of the interest rate environment we're in. And we're also seeing inflation start to bite. So we're seeing higher inflation in Ireland than we've seen for the last 20 years. So I do believe that a large part of the Irish public are changing their mindset in terms of how they might save for the longer term. And those points around deposits, rates, and inflation are pushing people to take a look at this. And I think that's a good thing. So very different, but a positive move.
And Ian, you showed on one of the slides about the recent pullback, which obviously is termed as a correction, and the way in which markets have performed over the last number of years, which has been phenomenal. And Zurich have been a fantastic manager, the best in my opinion. But what would you say to somebody who's worried about maybe investing at this time in respect of what they think could continue, i.e., this downward movement over the next 6 to 12 months, for example?
Yeah, do nothing if you're already invested is usually a good starting point. It does hurt. There are behavioral bias, as I said. Sometimes we have a strong urge to do something, but stick to your plan. I would always suggest, if somebody has concerns, is to pick up the phone or drop you guys an email, and you can talk through it. If your circumstances haven't changed, your plan doesn't, even if things are changing in the world. And look, I'm a big man for statistics. So in the last bull market, we had 11 years, and we had a correction or a 10% pullback in 8 of those 11 years. So there's lots of reasons to take you out of markets, but just stick with the plan, and ride through it.
And on a more general note, Ian, for people who are, I suppose, saving for different reasons, whether it be for a deposit for a house or for their kids' education or for their pension, how would you kind of, I suppose, judge the risk levels that someone should have? So, for example, if it's a longer term investment for their pension versus something that's shorter term.
Yeah, I think with the pension, it can be sometimes easier if you have that longer time frame. Is pick something relatively high risk up the scale and set and forget. You can put the money away, and that power of compounding when we showed the different ages, the start dates, I think that's really, really important. Also, pensions these days, you're probably going to continue to have an investment fund or a pension product in retirement. And we're going to all live longer on average than the last generation as well. So with pensions, I think invest early and often. There is an amount of risk that you would take or should take in terms of saving for a house deposit or the child's education. But just looking at one of the questions coming through, if that's in 12, 18, 24 months, that's a very short time period. So taking risk isn't really an option there. But once you're out over the 7 or 10 years, a lot of the same principles remain the same, or are there as well. Take sufficient level of risk, check in with your advisor before you do anything, and stick with the plan.
Very good. And Ian, there's a lot been spoken about the environment and obviously what's classed as ESG investing, which is, environmentally social governance. And can you just give us a kind of a very quick house view on Zurich's approach and whether you're likely to launch funds or what your general view is on this?
Yeah, so ESG and climate change and responsible investment, sustainability, these are lots of phrases we're hearing in the industry, and so we should be. There's a lot of regulation coming down. We'll have seen some of the plans from the European Union on the back of COP26 and things like that. So we do have an ESG strategy. We've had ESG as part of our investment process since 2012. I mentioned that we're an active investment manager. I think that's important. So when we invest in different companies, we have the ability to go talk to them, make sure that they have a climate, a carbon reduction plan, things like this, and we can choose not to invest in them. But we very much like to engage with companies and help them along the journey rather than just exclude them. That would be a big thing for us. But in general, we are making some changes and looking at things within our funds, but also very much aware of sticking to the consistent investment process that has served clients well for over 30 years. But in summary, it's a topic that's going to stay on the agenda, I believe, for the foreseeable future.
Okay, very good. And finally, Ian, for me anyway, just, I suppose, for anyone that's not familiar with Zurich, and I'm going to, I suppose, pin you to the wall here, why would you recommend Zurich over any of your competitors? Obviously, for those people that maybe have investments elsewhere or indeed haven't been exposed to Zurich. So here's your opportunity to maybe plug Zurich for a few moments.
Yeah, look, I think the track record speaks for itself in terms of the investment side, but a couple of things we would always point to is the strength of the company. And we are a very large global Swiss insurer, and we have a very consistent approach to how we manage money. We don't chop and change it. Active top-down approach has been in place for over 30 years, and we've been a constant in the Irish market since the 1980s with these sort of multi-asset funds. And I think ultimately what that really means for me is we've been there every step of the way, through the financial crisis, through COVID, through the dot-com bubble. And so we've been through thick and thin with it. And as I said, been at it for over 30 years and definitely will be for the next.
Super. Okay, well, I'm going to sort of have a look and see if there are any questions, or if anyone wants to ask a question, please feel free to to raise your hand on the chat. I think I saw somebody with a raised question, but one of the questions I can see here on the chat, Ian, and I'll throw them at you if you don't mind, is the market going through some more turbulence this month?
Yeah, definitely. So in a nutshell, what we're seeing here is that high inflation that's around the globe in the US. The central bank called the Federal Reserve in the US are now going to raise interest rates in America. And that's caused some turbulence, as the question says, in the US stock market. The view from Zurich is that equities can come through this. They just have to digest this news, come to terms with it, and they hopefully can move higher again. But if I was to point to one reason why we've seen a bit of a downturn at the start of this year, it's very much that relationship between inflation and interest rates.
Okay, very good. This is one, Ian. It asks about, I suppose you mentioned earlier about technology companies and the fact that whilst, generally they've performed really well, they've suffered a small bit since the start of this year. What's your general view on the tech stocks, just as a market?
Yeah, so we still do like technology stocks. I think it's worth noting, though, that that's a really, really broad church. There's software as a service, there's semiconductors, there's hardware, there's cloud computing, things like this. So when we say we like it, the sector, we do like technology, but we're very, very selective in that as well. So as an active manager, we're trying to pick certain companies in those sectors. So growth stocks do get hit with this interest rate narrative that's unfolding. But it's also, we like a company, we're willing to stick with it, and we'll hold it, and we'll have conviction in our views as well. So we would still we'd be selective, but optimistic on parts of the tech market. Yeah.
Okay, very good. Funny enough, I was listening to Owen McGee, who I used to work with, funny enough, a long time ago. And I know Owen spoke in a Zurich webinar that I was on earlier in the week. And he talks about this 60-40 rule. Now, I don't want to make any judgments about different investment strategies and so on, but he was referring to, I think, 60% invested in the market and 40% in bonds. What's your general view on bonds in overall, Ian? I know you said you were generally not as positive about bonds and equities, but just for people out there that maybe are not sure about which asset class they should be invested in.
Yeah, so bonds will be in general lower than that risk scale than equities, but you can still lose money in them, even if something's less volatile. When we look at this changing interest rate environment, as interest rates go up, or people think they might go up, bonds lose value. And that's kind of the environment we're coming into at the moment. And we've not been in that environment, particularly in the Eurozone, for a long time. So still less volatile when we're looking at government bonds. But the idea of de-risking definitely to bonds at retirement or close to a child's education, etc., some of that theory is being challenged a bit at the moment. And we're making particular decisions again as an active manager to make sure we protect our clients in that sort of environment. But overall, a lot of the theory we think about bonds might be shifting. So we're cautious.
Very good. Well, listen, I think that's about it for time. Thank you very much, Ian. I know there's a few questions that haven't been answered, but we will endeavour to get back to them, so we'll be responding. Just to mention, we are doing a follow-up Zoom session on income protection, which is another product that Zurich have just launched to the individual market. They've been providing that to groups, and that will form part of the session which we're doing on Wednesday, the 16th of February. And we will do more of these as we go further into the year. But look, I'd like to thank you all for your time. Thank you very much, Ian, for giving your time and your thoughts on the topic, which is really interesting. And